Hi, Jagruti. It's Ron. How are you?
Hey Ron, I'm good. How are you doing?
Doing well, doing well. We have one gentleman who's already waiting in the waiting room. I just wanted to go through a couple of things with you and Amanda quickly. This is basically the one placeholder slide. I'll do a quick introduction, talk about logistics, all audience members will be muted, et cetera. And then I'm happy to let you share your screen and do it that way if you like.
Yeah, I think that's fine. So Amanda is going to kick off because the first half slides are hers. So she's going to, I guess, present from her side, and then I'm going to take over from like midway, and I'll roll the slides from my side.
Okay.
I've done this on Zoom before, but essentially, if you want to share slides, we got to stop sharing on the other side first, right? I think that's the only way you can do it, right?
Yes.
Okay.
Yes. So what I'll basically do, I think you can automatically share though.
I can. Okay. Okay.
Or Amanda, whoever is taking over the slide. So I'll stop my sharing.
Okay. Yep. And then she can share from her side. Yep.
Yeah. So the moment I'm done, I'll say I'm going to turn it over now to Jagruti and Amanda, and then I'll stop sharing.
Yep. Okay. Sounds good.
Great. We'll probably start about 2 or 3 minutes after. Usually, as you know, a lot of people show up a couple of minutes late.
Yep.
I did also message.
Amanda, let me text her, see if she can get on a couple of minutes before.
She said she's going to be on in a couple of minutes. She just emailed.
Oh, she did. Oh, okay, great. I just texted her too. How's everything going on your side?
Good, good. Busy, as I'm sure all of us are. It's I know it's summer, and I keep wanting to say it's supposed to be a little bit slow, but it is not.
It's not. I guess that's a good thing in a way, but then you could take a break.
Indeed. Need to I'll need to decompress just a little bit. I'm going to put you on mute and put myself on mute for one moment. Have you been traveling much, Jagruti?
Actually, I'm in New York today.
Are you?
Yeah, I have a series of meetings, so no time, literally. Or I would have loved to stop by, and maybe we could have caught up somewhere.
That would be nice. I mean, I'm back in the city actually on Thursday. We could figure something out.
Oh, Thursday. Okay, I'm leaving tomorrow.
Ah, sorry.
Yeah.
One question: are you okay with the logos the way they are on the placeholder slide? You see that, correct?
Yeah, that's fine.
That looks fine. Okay.
Mm-hmm.
So I think the total count of registrants was something almost over 7.5 dozen.
Oh, wow.
Yeah, there's a lot of locations.
Yeah. And these are CPAs, right? Or at least most of them?
Most of them, many of them are CPAs. Some of them are not. Some of them are across the membership. So attorneys, technologists, bankers, a couple of hedge fund people, I think I recall saying.
Okay. And with CPAs, it's private industry and public accounting both, right?
Correct.
Because I kind of kept whatever I'm talking about not super technical, which is, I think that's fine. It caters to a bigger audience.
Yep. And Amanda, I just added you to the meeting. How are you?
I am well. How are you guys doing this morning?
We are doing well. So we were just going through some logistics. We already have 3 or 4 people waiting to be admitted. I thought we'd start about a couple minutes after. As you know, the bulk of people get in afterwards. You can see the placeholder slide there, right, Amanda?
I can.
So what I thought I'd do is I'd spend the first couple of minutes doing the introductions, mentioning that this is a 90-minute session, everyone will be muted, et cetera. And then I'll say, turning it over to Amanda and Jagruti. I will stop sharing at that point and you can share. I think you've got the consolidated deck, right?
Correct.
Yep. And so everyone will be muted. I will just make an action to make sure that you are both unmuted simultaneously, because you guys want to do that kind of back and forth a bit, correct?
Correct.
Okay.
So at the end, Ron, how would you like to handle the questions? Do you want to kind of be the moderator and ask the questions so that you can pick out ones that you feel will kind of speak to the larger audience, or would you like myself or Jagruti to go through the questions?
Sure. So what I'm happy to moderate, and what I'll be saying as part of my introduction is that please submit all of your questions by Zoom chat. And I kind of parse through some of those where there are gaps. I obviously will probably have 3 or 4 questions on my own as well. So, and I generally reserve the last 15 minutes or so for that. We'll see the questions coming in, as you guys know, throughout. But I'm happy to moderate and read those questions out to you guys.
Perfect.
Yeah, so at that point, Ron, I'm going to stop sharing my slide. Well, I guess it doesn't matter. I have the last slide anyway. So I guess I can just stay on my slide and I'm going to be like, all right, Ron, to be questions and then kind of hand it off to you.
Yeah, I think you could leave the last slide. It's a good ending slide, I thought. And then once the meeting's done, I can end the meeting for all on my end.
Okay, great.
Awesome.
All right, let me.
Amanda, I'm trying to send you a private message just in case we need to chat, but I'm not able to see the option. I see a group chat with Ron, you, and me. I think that's fine too.
Let me see.
No, actually, it's not even a group chat. I think it's just to Ron. How do I do it?
Yeah, it looks like you can only chat with the owner or the presenter. There we go.
So I got.
It was to everyone.
Yeah, and Jagruti, I do see your note to me. You should be able to privately text.
So I can probably chat only with you, Ron. I don't see the other option, but let's see.
You don't have the little drop down where it says to?
Yeah, it's not letting me do anything, which is strange. Usually it does. I know.
Yeah, I can only chat privately with Ron.
Mm-hmm.
Oh. Well, I will keep my phone handy, Jagruti, if you want to send me a text if you need anything.
Yeah. Okay. That sounds fine.
I'll check those settings next time, guys. Sorry about that. Not sure.
Oh, no worries.
All good.
Okay, we've got 11 people waiting. At about a minute or so before I'll admit all.
Cool.
And I will say, we'll start at about 2 minutes after. Is that okay?
That's perfect.
Okay.
So guys, I'm all excited. I went to an interesting meetup last night to discuss Libra coin.
Ooh.
Nice.
Yeah, it was a little bit of a logistical nightmare because it was actually at the Capitol.
Oh, God. Why would you do that to yourself?
And then some people, the audience was quite interesting. I felt for the presenters, of course, because I've kind of been on that side where the presenter was talking about the technology and the technical side of things, and someone raised their hand, was like, "But can you explain the economics of it?"
I love those.
Yeah.
That must not have gone that well.
Yeah. How do you get lettuce on a blockchain?
Do you remember Engage? Didn't we?
Well, I wasn't in that session, but I did hear about it.
Oh, that's right. That's right. That was Casey's session. It was that was a hoot. All right, 1 more minute. We've got about 20 people, 19 people waiting, and then I'll verbally announce that we'll start about 2 minutes after. Okay, I'm gonna do that now. Let me admit everyone unless you guys have an objection.
Nope.
Okay.
So good day, everyone, all of you who are on the call. We see our participants dialing in. We will be starting at about 2 minutes after the hour to allow a lot of our colleagues to dial in as well. So bear with us a moment. All right. Good day, everyone. Thank you all for joining us. Welcome to the WSBA special webinar on the topic of blockchain, practical applications for accountants. We still have some colleagues joining us. Today's presentation will be made by our friends and WSBA members, Jagruti Solanki of Aprio and Amanda Wilkie of Boomer Consulting. This 90-minute session will be recorded, so all audience members will be muted. At the end, for about 15 minutes or so, we will allow for some questions that we will read off here. So anyone interested in asking questions, we ask that you submit those questions via chat directly. And at that point, I will stop talking and turn it over to you, Amanda and Jagruti.
Awesome. Thank you so much, Ron, for that introduction. I'm going to go ahead and share my, my screen and share our presentation. So, Jagruti, if you see the presentation, just let me know, and then I'll go ahead and forward on to your intro slide.
Yep, looks good.
Awesome. There we go. Tell us about yourself, Jagruti.
All right, sure. So thank you everyone for joining. We are very excited to talk to you guys today about some of the practical applications of blockchain and accounting. I'm Jagruti Solanki. I'm a partner at Aprio. We are one of the largest regional CPA firms headquartered in Atlanta, about 500 plus employees today. I'm in the audit and assurance practice. Been with the company about 12 plus years, and my specialty is technology and blockchain. I dived into blockchain space about 6 years back in the audit space, and it's exploded in a good way since then. So excited to be here.
Thank you so much. So, a little bit about myself. My name is Amanda Wilkie. I am a consultant with Boomer Consulting. My background has always been in technology, but I've been working in public accounting firms for going on 15 years now. So I've worked in multiple firms in the top 50 before coming to Boomer Consulting, where I focus on primarily technology consulting and process improvement consulting with Lean Six Sigma. I started really getting into the blockchain space, kind of like you, Jagruti, probably 5 or 6 years ago. I was, from a technology perspective, was extremely fascinated with the technology, especially when folks started asking me, knowing that I worked in public accounting and had a technology background, they started asking me things about Bitcoin. So I decided I would start doing my research there. Before we actually head into what to expect today, Jagruti, I had a revelation over the weekend. I was thinking about our presentation today, and you worked at Aprio back 2008, 2009. I also worked at Aprio back then. So you and I actually worked together when the Genesis block of the Bitcoin blockchain was generated. And in some ways that feels like yesterday, and some ways it feels like it was decades ago. So I've got to ask, back then, did your crystal ball really predict that you would have this new technology or a new computing paradigm, new services, and really a new niche to really talk to your clients about today? Did your crystal ball actually predict this?
I wish it had, because I would be probably a billionaire by now. But yeah, I was like 6 years back is probably the first time I started getting in the space, not knowing blockchain even existed. This is like back when I was like, oh, Bitcoin is the same thing as blockchain. So that was my level of education 6 years back.
Yeah. And I've got to say, the technology has changed, so rapidly. So some of the, the case studies that we're going to share today, I will also share why they really spoke to me and why I was impressed with them. But as Ron said, we're going to shoot for about 75 minutes of presentation, and then we'll do, 10, 15 minutes of Q&A. And I am just so excited to be able to present with you again, Jagruti, because you and I got together. We did a 3-hour presentation for the AICPA at the Engage conference back in June. And I know we've had this conversation. That 3 hours seemed like it was, like 15 minutes?
Yeah.
Yeah, so I'm glad we've been able to strip this down and really focus on some of those use cases. And then, of course, I'm going to let you tackle the audit and the risk considerations for us. Does that sound good?
Sounds great.
Okay. Then let's get into it. A couple of things that we're going to talk about today, really two overarching technologies or concepts, if you will. We're going to talk about smart contracts and something that I'm getting very excited about these days, self-sovereign identity. So that's what we're going to tackle first. And I will go into kind of a definition of a smart contract. And it fascinates me because, of course, these are neither smart nor are they actual contracts. But the concept of the smart contract actually dates back to the mid-90s. And if you think about what was going on in the mid-90s, it's very similar to what we have going on today. So in the mid-90s, we had this new thing called the internet. We were trying to figure out how are we actually going to use this new technology, how we're going to use this new platform, and how we're going to use it in business. How are we going to use it to improve the way that we do business and the way that we share information between individuals and between business entities. And if you, again, thinking back to the 90s, that's when we really had the concept of e-commerce be developed. I mean, we really didn't talk about that until the mid-90s. And of course, with e-commerce, there were all kinds of challenges that came up, primarily around security and security of personally identifiable information. Well, today we're asking ourselves, how are we going to use blockchain? No matter how you really define it, how are we going to use it in business? How are we going to use it to improve the way that we not only share information, but how do we use it to improve the way that we transfer value, that we provide, commerce? There's a ton of questions that are still lingering out there. And I think, Jagruti, you and I can really attest to the fact that, 10 years ago, it was truly a lot of questions. We still have a lot of questions, even though the technology is rapidly changing. So I would say with smart contracts, that's something that I like to keep in mind. Again, they're neither really smart nor contracts. They're actually, code, computer code that can be used to enforce a contract. So it can show proof that certain conditions were met or not met. It can actually replace the functionality of those intermediaries. And when we talk about blockchain and we talk about smart contracts, we often hear about how those intermediaries are actually going to be disrupted when actually the technology can support them in many ways. So I like to always share that smart contracts are actually going to result in more automation. I would say a smart contract is really the next step in automation. So it can automate, the contract. It can monitor and enforce the contract. So it does help to improve that efficiency. It helps to reduce the amount of time it takes to for settlement. It can reduce operational errors and human error. And then, of course, it can, in some places, definitely not in all places, it can reduce the ambiguity of a contract by actually translating the terms into computer logic. Now, before I go into an example here, Jagruti, is there anything you would add to that definition of smart contracts?
No, I think you covered it pretty well. I mean, end of the day, the way I look at it, it's you know, to your point, it's not smart, it's not a contract, it's just a set of codes that's really reacting to some sort of conditions that are set to trigger an event. So yeah, I think you explained it quite well.
Thank you. So I'm going to move into this example. And I have to give a shout out to the Blockchain in Transport Alliance if those guys are on the line, because this example was actually presented during a WSBA webinar last year. And it really, really stood out to me for a couple of reasons. One, I think it's a great illustration of a smart contract, but additionally, you know, where I grew up in North Georgia, close to Chattanooga, Tennessee, my first job, actually I was still in high school, I worked at a trucking company. And I worked in the department that audited the truck drivers' logs. So what would happen is the truck drivers would bring in, you know, receipts from where they stopped for fuel or when they got their loads weighed, and we had information from their GPS. We had information from, you know, the shipper where they got their trucks loaded and things like that. And we would actually have to piece together and make sure that they were adhering to all of the regulations out there around transportation. And one of those is the limit to which they can legally operate the vehicle. So drivers can legally operate up to 14 hours a day, and only 11 of those hours can actually be when the truck is moving. So everything else is considered on duty but not driving. So if you add up lines 3 and 4 of this this example of a truck driver's logbook, that can't actually go over more than 14 hours per day. So anytime the driver stops for fuel, again, if they're stopped to get their truck weighed, if they are being loaded or unloaded, all of those things will go on line 4. And if that goes over the 3 hours, then that actually cuts into that 11 hours of drive time. Now, cutting into that 11 hours of drive time means that shipments can be delayed. It means that the driver isn't moving. So if the truck isn't moving, the driver's not making money, the company is not making money. So many companies have what they call a detention contract. So in this example, Jagruti, if I'm the truck driver and I show up at your facility and we have agreed that you will actually unload my truck, reload my truck, and get me out of there in 90 minutes. So we've agreed that the acceptable time for that to take is 90 minutes. Well, if we go over that 90 minutes, it's possible that you are actually causing me to be delayed longer than we really had to. So say I show up, I don't get unloaded, I am there for more than 90 minutes. You know, blockchain can actually automate this part of our relationship. It can automate this part of the contract. So how that would work is, of course, I pull into the loading dock. It would probably take me a good, we'll say, half hour to actually get the trailer into the loading dock. But once I did, you know, IoT devices can track how long it's taking to unload that truck. The IoT devices, the GPS is tracking, you know, when I got there, how long it took to unload it, how long it took to reload it, and when I actually got out and pulled away from the dock. Now, a smart contract would actually take that time, so the time that I left minus the time that I arrived, and if that's more than 90 minutes, this smart contract could automatically transfer funds from your wallet, your account, to my wallet or my account, or actually it would be my employer's. So that's an example of what a smart contract is and how it could possibly automate a piece of the contract, a detention contract that you and I have, Jagruti. However, there are some definite challenges. And I think, again, this is a great example to illustrate some of these challenges. So, you know, all the possible outcomes may not actually be addressed in the contract by design. You know, there's a lot of flexibility built into some contracts. It can often be difficult to renegotiate once we have a contract, once it's become a smart contract. So that means it's become code and it's actually in use out there. It can be difficult to renegotiate them or to redesign them. There could definitely be some issues with settlement. So for instance, I bet we would dispute this if I showed up with this trailer. There's no way, Jagruti, there's no way that you're actually going to unload that trailer and get me back out of there, reload it and get me back out of there in 90 minutes. It's probably going to take more than 90 minutes for me to explain how the trailer ended up in this condition anyway. And then another, outstanding question is, with smart contracts, is an invoice, is it an invoice? Is it a debt? Is it payable? What exactly is it? If we have entered into a contract, we have automated that contract with a smart contract, we have both contributed money to the smart contract, and then that money is basically being settled on through a blockchain application. How does that actually end up on the books? And I think that's something that's still a bit questionable at this point. Or I should say, there's a lot that goes into answering that question. So here's another use case that really stood out to me. It's a company out of Ohio. I saw them present at a presentation at a conference earlier this year. And what they're doing is they're actually building a blockchain-based solution for car titles. And the name of that solution is called Champ Titles. And for many reasons, when I heard their founder present, there were many things that stood out. One, they said that they had an error-prone, paper-based process that really took a lot of time and a lot of money in the U.S. So in the U.S., there's about 263 million vehicles that are registered to their owners. And again, to get those registered, it's a manual, paper-based type of process. So by using blockchain, they're saying that, of course, it'll be online, there'll be enhanced security, enhanced efficiency, not just to the owners, but state governments, law enforcement, so on and so forth. So what really stood out to me when I heard these guys speak was that, this was actually one of the early examples that I always heard about and always talked about, with how blockchain would actually change the way that consumers and retailers would interact. Again, when I started researching blockchain years ago, you would hear all of these things about how it was going to change the world. It was going to automate everything. There were going to be no middlemen in anything anymore. And I was fascinated by it. I didn't understand, how they were going to accomplish it. but I was fascinated by the idea of how blockchain would change some of these interactions. And so one of the things that I always heard about was, hey, wouldn't it be cool if you could take your cell phone down to a car lot and without waiting on insurance companies, without waiting on the banks, without waiting on the local government to register the car, you could actually use blockchain-based systems and automate that entire process, from getting the loan to registering to getting car insurance. So when I heard about this tool, Champ Titles, I thought, wow, that's a piece of it that is actually coming to fruition. So that's one that I've been sharing recently. Another thing that stood out in the conversation about Champ Titles is, if you'll notice, they've taken blockchain, they've really taken the word blockchain out of the conversation. And they've started talking about this belted technology. Now, belted stands for blockchain encrypted ledger that's executable and distributed. Now, they found that when they went in and they started talking to car dealerships about this technology, about blockchain, people started shutting down. You know, kind of like you, Jagruti, when you first started learning about blockchain, it was all associated with Bitcoin. And so these business owners, these car dealerships, were very, very similar. You would say blockchain, they immediately went to the negative connotation of the word blockchain, and they would shut down the conversation. So what this organization has done is they've actually taken the conversation and changed it to something that actually makes more sense to the customers that they're talking to. So they no longer talk about blockchain technology, they talk about belted technology. And in the automotive industry, that word makes more sense than blockchain really makes. So let's actually talk about the conversation that we should have with our clients. And Jagruti, you and I used this tool when we spoke together last month. We've actually used it with quite a few firms to start developing use cases and, again, start talking about blockchain technology within their firms. So this is a little decision tree to get the conversation going. The first question is, is there a need for a shared type of common database? And in this example, yes, of course, car titles, they change hands multiple times throughout the life of the car. And that current process is extremely lengthy. It can take weeks. There's a lot of human interaction in it. So of course it's prone to possible mistakes. So the next question is, are there multiple parties involved? Well, yes, there are, the manufacturer, there's the transporters, there's the dealership, the buyer. The list really goes on and on. It goes all the way from the consumer, the lender, the state agencies. There's a whole long list of parties who need access to the information in this shared common database. Now, do the parties have conflicting incentives? They want to trust each other, but maybe they don't. Well, yeah, buyers don't necessarily trust the car dealerships. I can't tell you, well, it's been a long time since I bought a car, but that experience was not one of a lot of trust, right? I was trying to get the best deal. They were trying to make the most profit. Not a lot of trust in that relationship. Same goes for lenders and dealerships, insurers and buyers, so on and so forth. So there are quite a few parties involved that have some conflicting incentives there. Our next question is about the rules governing this process. So the rules governing the process, are they uniform or are they not? And in this example of using car titles, the process may differ from state to state. It may differ from lender to lender. dealership to dealership. So they're not very uniform. Now, there's the question, is there a need for an objective immutable log? Well, if there's a need for a shared database, there are multiple parties involved, there are conflicting incentives between those parties, then yes, we could definitely benefit from a objective an objective immutable log. So what would be tracked? Everything from the certificate of origin, the bill of lading, the car title applications, liens, odometer disclosures, all of these things that, again, are kind of tracked manually now, could be in this immutable log. And then the last question are the rules of the transactions do not change frequently. So most rules are governed by local, state, or federal law. And yes, those things definitely can change, but I think we all know how slow it can be at times to actually change some of these laws. Again, I'm going to pause, Jagruti, and see if there's anything you would add to kind of these questions or considerations.
No, I think this is a great way for companies and for companies looking at blockchain solutions to actually think about how do you actually create the platform to begin with, right? And from an accounting standpoint, I feel like this is a great process where pretty much every process that you laid out here is where we as accountants can think about how do you now take each of these processes and consider what sort of controls to put in place as you're going through these processes. Like, for example, the third process that talks about, parties having conflicting incentives and or are not trusted. I mean, I can pretty much think about, putting controls in place where you are restricting access to parties for certain type of information as you are building the solution to make the blockchain platform much more effective. So I think this is a great way to lay down a process and then add to it all the financial level controls.
Yeah, that's an excellent point. And when I talk to firms and they're asking or they're saying, well, I still don't understand, my firm still doesn't understand how blockchain is going to impact the firm or really impact our clients. And that's a great place to focus right now, is how is blockchain going to impact your clients? So even sitting down internally and going through this process and asking, the questions, these questions, you can start discussing. I mean, no one knows your clients better than you do. So you can start actually discussing how blockchain is going to impact your clients. You can get those clients involved in answering some of these questions as well. So again, a great tool to really start the conversation with your clients or within your firm as well. Now, Jagruti, I'm going to share this one. This was a great solution that I came across. I actually met the founder of Afloat at a conference last year. And since then, she has stayed in touch with some of my colleagues. I've had multiple conversations with her as well. But this example, the example of using blockchain for transferable tax credits, really stood out to me because when I left Aprio there in Atlanta, I went over to what was then the Atlanta office of Resnick Group. Of course, we merged and became Cone Resnick. But the Atlanta office there had a huge low-income housing tax credit niche. And I had no idea. Again, almost 15 years in public accounting, I am still amazed at what all goes into public accounting. But I had no idea that this was a thing. Although I know now Georgia, I no longer live in Georgia, but Jagruti, I know you still live in Atlanta. How has the film industry coming to Atlanta impacted Atlanta's traffic? Has it gotten better or has it gotten worse? You have a lot of shut down roads when things are filming?
Well, traffic is always an issue, and with the filming, with all the with I guess the Hollywood coming here, it's definitely got very lucrative for the state from a tax credit standpoint. Traffic is just getting worse. So
Yeah, I'm not sure. Ooh, that's a good question. How could blockchain actually improve traffic? I think I'm sensing a future webinar.
yeah,
um, but my time there at Cone Resnick and learning about transferable tax credits was, it was extremely interesting to me. So I think there are more than 30 states now that provide some sort of transferable tax credits. So whether those are entertainment, so like we just discussed, all of the incentives to bring Hollywood into Georgia. There are low-income housing, renewable energy. I know that historical real estate preservation is really big as well. So a lot of states have these transferable tax credits in these areas, and of course there is a huge risk on both the buyer side and the seller side. Both want to make sure that they're getting the best deal. They're making the most money out of it. There's some risk around, could there be fraud involved? Could the tax credits be, rescinded because of such fraud? So on and so forth. So some of these are actually selling, of course, they're selling for less than face value, but someone really has to broker these deals. So sometimes you have a broker, you have lawyers, you have accountants, and when I see brokers, lawyers, and accountants all in the same sentence, I just hear cha-ching, 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 cha-ching. Not only is it expensive, but it's an opportunity for us as well. So when I spoke to the founder of Afloat, who is a CPA, her name is Louise Reed. She is a CPA. She found herself kind of being that middleman, and she had that professional obligation, or felt that she had this professional obligation to really do the best for both sides, which kind of put her in one of those awkward positions. And she found an opportunity for improving this process using a blockchain-based system. Now, I will say I think that Afloat is it's very much in its infancy, but it's definitely one to watch out for. So they've developed a minimal viable product. The platform is complete. In some recent conversations, I found it interesting that their story is really starting to shift. So it's not just about cost savings; it's about providing that transparency and the efficiency, and giving someone more control over the projects that they're really investing in. Additionally, I found it interesting that they moved from Ethereum to Corda, because again, when you start having that conversation with clients and with people who have heard some of the negative things about public blockchains, yeah, Ethereum may work, but it may make more sense or be more practical to move to something like Corda, which is a private blockchain, a private platform. So when you start having that conversation with potential investors and potential clients, that becomes a different conversation. And it can be a difficult conversation when you find yourself up against those the negative perceptions of blockchain in general. Okay, I'm going to move on to self-sovereign identity. And this is somewhere that I get super excited, Jagruti. So I apologize if I get really excited about this. I geek out on it. Actually talking about and reading about self-sovereign identity today in 2019 reminds me of how excited I was about blockchain, 5 or 6 years ago, when I started looking at self-sovereign identity and studying up on it, my first thought was, this is really cool. This is a big deal from a technology standpoint. I have no idea how they're actually going to pull it off. So I really look forward to seeing how self-sovereign identity and how blockchain changes the way that we look at identity over the next few years. So self-sovereign identity, as defined, it's a decentralized, portable, secure, privacy-respecting, entirely user-controlled digital identity. What does that really mean? Well, we'll get into that. But blockchain is the tool that is going to make a self-sovereign identity possible, or at least get us closer to self-sovereign identity. So to think about self-sovereign identity, let's actually back up and look at the evolution of digital identity. So we have the first phase of digital identity, which is really a centralized phase. So it is controlled by a single entity. You know, it's definitely fragmented systems. I remember one time I needed my birth certificate, Jagruti. I was living there in Atlanta. Actually had to drive up to where I was born because that was the fastest way at the time for me to get a copy of my birth certificate. So if you think about birth certificates, driver's license, those things are really centralized identities. You know, phase two of the evolution of digital identity is really where we're at today. So that's federated identity. So we have the same credentials with multiple systems, but it's still controlled by a service provider. And I still use this stat, even though it's a few years old. But each individual has at least 25 different websites that they visit on a regular basis that requires a username and password. Well, I hope anyway, we've gotten away from the password 123 as our go-to password, because with federated identity, what happened was Facebook, LinkedIn, Google started popping up and saying, do you want to use your Facebook login for this website? Sure, it's one less password I have to keep up with, one less password I have to try to remember. By the way, each individual out of those 25 websites, we have an average of 3 passwords because that's usually when the system locks you out. So I know when I set up a new password, it's probably one of 3. I don't. That's our typical individual. So out of this federated identity framework, we were able to make it a bit easier to log in and use passwords or use accounts so we don't have to remember passwords. But what has happened now is that all of our identity is now controlled by LinkedIn or the Facebook or the Googles that are providing us that authentication mechanism. So even if I wanted to take a break from social media and get rid of my Facebook login, my Facebook account, or get rid of my LinkedIn account, my identity in so many other areas is actually tied back to that Facebook account or that LinkedIn account. So I can't actually get rid of that identity without impacting the identity that I've built on so many other systems. So that's where we're at right now. Phase 3 is really a user-centric digital identity. So this idea is that it would be fully portable and it would be user-controlled and it would be secure. However, we've tried this a little bit in the past. So there have been initiatives such as OpenID and FIDO, which is a fast identity online. I think they launched back in 2013. And their mission was really to develop and promote authentication standards that helped actually reduce our reliance on passwords. But unfortunately, I think they've struggled with some of these, and the attempts have kind of fallen short. Because even though people were not under control of the service or the application or the provider, they were still, those digital identities were still maintained and controlled by an entity that provided those digital identity services. So I think with blockchain, though, they'll definitely make some progress in that area, because where we're trying to get to, again, I'm not sure how we're going to get there. I'm confident we will get there, is a self-sovereign identity. So where people have control over their identities, their digital identities, including control over who has access to it. So this will really help enable businesses to reduce the amount of personal data that they're required to actually required to collect and then maintain in their organizations. Not sure if you heard, I think it was at Capital One. I hope it was Capital One. If not, I'll have to apologize to them. But I think it was 100 million people had their identities actually compromised just this week. So if we can actually reduce the amount of personally identifiable information that is out there, I think that will really help to improve identity and help reduce some of these threats that we see with identity issues. So the impact of a self-sovereign identity model is pretty interesting. It really changes the role of players out there like Facebook and Google and LinkedIn, who currently own our personally identifiable information. They currently own our identities, because each time we set up a new account, we're setting up a new identity, a new username, a new password. That's a new identity. So it really changes the role of players out there who attest to our identity, like Equifax and banks. It will change the way that we handle KYC and anti-money laundering. Again, if we don't have to save this personally identifiable information, it actually reduces the threat vector out there. So as CIO of an accounting firm, cybersecurity was definitely one thing that kept me up at night. So if I could reduce the size of personally identifiable information, it would reduce that threat vector that could possibly exploit, or compromise data in my environment. And I should actually go back and mention, right now, KYC and anti-money laundering efforts currently cost financial institutions more than $60 million annually, just in those efforts. So again, some of the things that really stand out to me from a technology standpoint is if I can handle identity and access management, if I can reduce cybersecurity threats, if I can help make data integration and make data sharing easier and more flexible, while also reducing some of the challenges with KYC and AML efforts, then I would say self-sovereign identity is a huge initiative that I would be interested in right now. Again, I think it's still pretty young of an initiative, but it's definitely one to keep an eye out on. If you want to get really excited about self-sovereign identity, I do recommend the white paper from the Sovereign Foundation. They had a great white paper that kind of outlines the concepts of self-sovereign identity, as well as some of the challenges with self-sovereign identity as well. So before I hand it over to you, Jagruti, I just want to stress to the folks who are with us here today that there's a huge opportunity out there for CPAs. We have the opportunity to really educate our clients and learn with our clients. If we don't do it, someone else will. So right now, even though, Jagruti, you and I have been studying and talking about blockchain for 5 or 6 years, it's still a very young technology. You still have the opportunity to go to your clients and say, this is new, we're learning it together, let's learn it, let's talk about it together. Because if you wait, as an accounting firm, if you wait 3 or 4 years and your clients start calling you saying, hey, I've heard about this new blockchain-based system, what do you think about it? What do I need to know? If you don't have the answers at that point, then we've lost the client's trust. We may have lost the client because there are firms out there that are working in this area and are having those conversations. So with that, Jagruti, I am going to hand it over to you. Would you like me to stop sharing my screen, or would you prefer me to run the slides for you?
You can stop sharing. I'll share on my side.
Perfect.
All right, Amanda, can you see my screen?
I can.
All right, so thanks a lot, Amanda, for that great overview and some really good applications of blockchain from a use case standpoint. I think that it definitely helps connect with what companies today are actually doing using these blockchain applications. And to your point, I think the technology is changing so fast that if we don't jump the ship now, it's just going to be, it's just going to be a little too late. Like, for example, I'll pick on Walmart. Last year, they announced that they are going to pretty much mandate their vendors in the produce side of business to use their blockchain application to be able to do business with them. So companies like Walmart clearly have the resources to build a application that costs a lot, clearly, but also kind of spend the time and resources for trial and error. How about those small vendors or the mid-sized vendors who are reacting to someone like Walmart versus being proactive, right? Those vendors, we got to figure out a way to help them, to educate them and prepare them for what's coming. So, one of the things, 6 years back, we got our first call, our first blockchain-based client. And I'll be honest, like back then, and not, as I said earlier, in my mind at least, Bitcoin and blockchain wasn't, I really didn't differentiate between the two. I had to study the space. Like, we had to roll up our sleeves and understand what this technology is about. What do we need to do to help our client? And that took a lot. Today, we have over 35 to 40 blockchain companies that we are working with and helping with a wide variety of situations and complexities. Like, we have seen scenarios where, just kind of looking at the crypto side of blockchain. Like, when I think about blockchain, I'm looking at two aspects: as the crypto and the digital asset side, and then the other side is the enterprise side, what I kind of would put someone like Walmart in that space, using private or permission-based blockchain. So just on the crypto side, I mean, that's already happening. Companies are using digital asset in some form or shape to as some sort of application for their business. It could be a token. Token is essentially a representation of some form of service that the company is providing or intends to provide. We have seen situations where companies are coming up with creative plans to compensate employees, third-party vendors, and outsourced contractors with tokens. So how does that impact what we are doing from an accounting standpoint, given the lack of guidance on the tax and accounting side? I mean, end of the day, we still got to pay taxes, whether it's, whether an employee is getting paid in fiat, US dollar, or he's getting paid in tokens. You still got to do what you got to do. It's about changing the way we look at things and helping these companies understand that there are implications regardless of how you do your business. We have seen clients I would say probably about 2 years back, or maybe 2.5 years back, we saw a lot of companies where based on some guidance, that they may have received outside of the US, these companies ended up setting up a company, or the US investors, created companies outside of the US to somehow navigate around SEC securities law and to get some sort of tax savings. Well, it turns out, it was probably just a one-sided opinion more from what helps the company outside of the US. Well, you still have some US tax implications, and those needed to be considered. So we have seen a lot of structuring and international restructuring in past couple years. And honestly, there is really no checklist. We as CPAs, and I'll put myself in that bucket too, I'm on the audit side, and usually what we are used to seeing is some form of checklist. There's a guidance, there is some sort of direction from FASB and IRS, and we are following those routes. Well, this is a new industry, new space. There are no rules yet, at least not as clear as what you would have for a traditional non-blockchain based company. So we were kind of pretty much forced to create best practices for pretty much every kind of situation that we saw with our blockchain clients. Now, to that point, one of the first situation that we had to deal with, just talking specifically about accounting, and by the way, today I'm not going to cover much or probably nothing on tax part of it, but that is another big area where companies need to consider implication. I'm going to focus mainly on accounting and audit standpoint because that's my area of expertise, and we have tax partners who deal with the tax side. So one of the first things we dealt with when we looked at just accounting for digital assets is, whether it's Bitcoin or Ether or any kind of token that company may have received, any kind of digital asset that company may have received when they're issuing tokens as part of their token sale process, how do you account for these digital assets? Is it cash? Is it considered a foreign currency of some sort? Is it a financial instrument or inventory or commodity or intangible asset? So we pretty much went through what existed in current guidance, the framework of what current guidance already has, and use that to customize for a digital asset type scenario. This is past several years, we have seen a lot of peer companies go through the same exercise, and based on what we are seeing at a high level, sounds like today, if you have to account for digital assets, they may not meet the criteria of the digital asset being cash, foreign currency, or a financial instrument, just because it's not really a legal tender of some form. It's not a legal contract just yet, and they don't necessarily fall in those definitions. The closest we are seeing that these digital assets falls within the definition of either an intangible asset or some form of inventory based on the nature of the company. I mean, if you're a mining company or if you're an exchange, you have to revisit the definition and see where your digital asset really falls under. What is it closest to in terms of the definition, and then kind of follow the accounting guidance for that respective asset. So say, for example, if your digital asset, Bitcoin, Ether, any other crypto is classified as it falls under the definition of intangible asset just because of its intangible nature, then today's accounting guidance pretty much tells you to record these assets at cost basis and it's subject to impairment, which means that anytime the value of that asset reduces below the cost value, you have to record an impairment expense on your P&L. Okay, so think about how this is going to impact your financial statements, and considering the volatility of crypto, it's become a nightmare for companies to just track basis. Like, if you are a company that has a huge volume of crypto ins and outs, now you got to track cost basis of all your incoming crypto, and pretty much track what's the value of what's remaining, so you can figure out at what point the cost was below the basis at which you purchased, and record and calculate your impairment expense. There's another approach where there's a fair value measurement approach, where if your digital assets, if you are a company that has elected to do fair value measurement and you fall under those definitions, then essentially the company is marking up their digital assets to fair value on a regular basis. In most cases, it's daily basis, and the change in the value of that asset is treated as an unrealized gain or loss, for GAAP purposes at least. For tax purposes, the unrealized portion of the change in the value is not considered. So you got to add that back. So now, if you're using the fair value measurement approach, you're pretty much, looking at two sets of books, one for GAAP and one for tax, and then maybe you have another set of books for your internal management purposes. So that was pretty much the first consideration that was given when we're looking at what a company with digital assets needs to do in terms of accounting. We saw a lot of companies where they ended up doing token sale, issued tokens created out of some form of smart contract, and received some form of digital assets in exchange of the tokens that they issued. And these tokens, as I said earlier, there's some form of digital representation of a service. It may be backed by an asset, it may not be backed by an asset. So a wide variety of functionality or utility attached to the token. As accountants, I think it's very important to first understand what is the utility of the token. What is the company's intention when it comes to using that token and allowing their customers to use their token? Is there a plan to charge the customers or the holders of the tokens some point down the line when those tokens are ready to get redeemed in exchange for some form of service? All of these questions will impact how you end up accounting for those token proceeds. Are the token proceeds revenue or some form of other income? Or they could be, some form of liability like a deferred revenue, or maybe they have equity features. If those tokens, if the holders of the tokens are getting some form of dividend or a profit share, or some form of equity incentive. So all of those considerations need to be given and thoroughly examined before an accounting approach is taken. And then again, keep in mind, there's the GAAP accounting, and then we get to the tax accounting, which is another set of books altogether. We also see a concept called simple agreement for future tokens, common amongst a lot of companies that did some form of token raise. Essentially, the SAFT, or the simple agreement for future tokens, it's a promise to issue tokens in the future or at a token generation event in exchange for he may have received in form of a loan. Now, some of those loans could have convertible features, which then means that as accountants, we got to look at those conversion features and understand and see how it needs to be recorded on your balance sheet in the liability or a mezzanine section between liability and equity. So that classification and distinction needs to be drawn. And for something like a SAFT, once you recognize the liability, obviously the next question is going to be, how do you de-recognize the liability and at what point? So I guess one of my biggest suggestion is, if you have companies where you have these kind of situations and scenarios, the best way to help the company is to understand the nature of the platform, the digital asset itself, the features, the utility, and create your own checklist to be able to help them. I'll very quickly brush on some of the other industry trends that we have noticed in the crypto or the digital asset space. Something like a fork, airdrops, giveaway. Just picking on forks, for example. Forks didn't even exist a few years back. It's a relatively newer concept. Just picking on Bitcoin, for example. Just Bitcoin itself had, I believe, today over 80 plus forks. Essentially, it's kind of a spin-off from an existing fork, and a new blockchain is created as a result in most cases. The question for accountants becomes that if you are a company that is entitled to an asset that is a result of a fork, how do you recognize that asset? And at what point do you recognize an asset? Like, for example, a few years back, Bitcoin forked into Bitcoin Cash. Well, when Bitcoin forked into Bitcoin Cash, at that point, Bitcoin Cash was probably worth nothing. Today, it's worth a lot. And when the asset was forked, the Bitcoin Cash just didn't show up in your wallets. You had to do something to claim it. So the question then becomes, do you recognize an asset that you are entitled to at a point when the industry makes a decision that now we created this asset, or when you actually claim the asset? So those kind of decisions need to be made. And at this point, it may even be a company policy, some form of election that the company needs to make, that, for example, we are going to record a fork only if we claim it and go through a certain set of procedures. The next question or an issue for accountants is, if you're looking at the top 10 cryptocurrencies that are in multiple exchanges, you're probably not a big deal on valuation of that digital asset. But if you're talking about tokens and cryptos that are, that are not as liquid, then the biggest issue is valuing those tokens. We have seen companies where companies are paying their self-created tokens as incentive to employees, as some form of stock option, in some form of stock option plan. There's a lot of subjectivity and management estimates involved in determining the value of that token at the time of issuing them or granting it to the employees, and then another point when they actually exercise it. So a lot of complexities when it comes to valuation and significant estimates and judgment used, which, to be honest, whenever it comes to significant estimates and judgments, it's not the best friend of auditors. We love to drill more into it and figure out what are we talking about here. So here on the next slide, I have a snapshot of a wallet report. Most of the companies today, if they have digital assets, they will have some form of wallet. This is a standard report that you would normally see from a wallet of a company. In this case, I called company ABC. All you will be able to see is the to and from address and the date, the number of crypto, and the type of crypto. This is kind of a standard wallet report. There are other wallets today where they're adding features to put in more information. But if I'm an accountant of a company and if I'm getting this report, I'm most likely going to be clueless unless, as an accountant, I do a very good job in making sure there are proper controls in place to record the nature of these expenses as they are incurred, to make sure there's proper supporting documentation, to verify who is that crypto going to. Like when we say it's coming from so-and-so address and going to that string of alphanumeric digits, how do I know that address belongs to the vendor that, you know, that the purchase department may have told us to send the crypto to? So documentation of to and from and who these addresses belong to is extremely important from an internal control and best practice standpoint. The other thing is, you know, when it comes to crypto transfer, with the new tax law, IRS pretty much said that anytime a company is trading a crypto to buy another crypto and then selling that crypto to buy, you know, some other token, you're triggering a taxable event at every single change of crypto, at every single point. Just because you know, you put in cash into an exchange and you traded a bunch of stuff within the exchange and liquidated after, say, you know, a long period of time, it doesn't mean that your taxable event triggers only where you have the US dollar connection. It triggers at every point you exchanged a crypto. It's been an accounting nightmare for companies trading in crypto or you know, trading in crypto to track their cost basis, because that's one of the things you need to estimate what your realized gains or losses are. There are accounting softwares today who have done a pretty good job in trying to automate the basis calculation, trying to automate the gains and loss calculation, in some cases calculate the fair value, which helps us from a GAAP standpoint to estimate the unrealized gain or losses. So there are tools today that help with that process. But then again, you know, given the nature of industry and the pace at which it's changing, there is still a lot of work that still needs to be done. I have this snapshot here just to show you guys what a block explorer, which is pretty much like the internet of the particular blockchain that we are looking at. So in this case, it's Etherscan. It's like the Ethereum's block explorer. You can pretty much search any address that you want in the search bar there, and exactly be able to tell how many cryptos were traded at what exact time, and also get an estimate of the value based on that. But that's about all you can tell. When we say public blockchain and, you know, everything is public information, this is the only piece that's public. All you can see is the address and the number of crypto and the timestamp. You can't necessarily tell who and from where. This is another snapshot I have here, kind of showing the face of Ethereum's block explorer. We have the same thing for Bitcoin block explorer as well. So now that being said, I really wanted to give you guys an overview of the digital asset, the challenges of accounting with digital asset space, and moving into the enterprise blockchain, where, you know, Amanda touched a lot on the smart contracts and some of the use cases there. I think it becomes extremely important for accountants to understand what these smart contracts are doing. You know, to Amanda's point, a smart contract is not necessarily a contract, and it may not be smart unless we make it, you know, do smart things. It's just a bunch of codes. It's programming codes that is supposed to execute when a triggering event occurs, or based on how you make the smart contract react to a business logic. So it's pretty much automating business logic to perform some form of transaction or to initiate some form of transaction. So now that being said, as accountants, you know, if I have to that code of a smart contract, I mean, I don't think I'm going to follow what that code says. And you know, depending on which programming language that code is written, you probably most likely need an expert in that particular code to be able to read that code in English and tell exactly what that code is doing. So one of the fraud considerations, if the company is using a smart contract could be, something as simple as, how do we know that there is no backdoor in the code somewhere? How do we know that, there's nothing in the code that may have said something in the lines that, oh, for every transaction, 0.001% of the transaction fee needs to go to wallet number Z, and that wallet number Z could be, a wallet that is not authorized by the company. How, as accountants, can we figure out that the code is everything that it's supposed to be and everything that the company has authorized, and there's no unauthorized transaction that the smart contract will execute, and there's no fraud risk related to that. So accounting and audit, I think it's going to be very important to audit the smart contract itself, not just from a coding standpoint, but then connecting it to the business logic and taking it down all the way to internal controls put in place and making sure the right parties are doing the right thing. The right parties have permission to do the right thing. And the appropriate parties have access to seeing appropriate information. So all of those need to be verified when we are auditing a blockchain-based company that is using a smart contract. One of the challenges, I see this a lot, where today, if we think about blockchain, we like to think about blockchain as a subledger. I mean, the way I think it's probably another few years from now where I can totally see where a blockchain subledger could be the source of information for what makes it into your main ERP system, whether it's NetSuite or Xero or QuickBooks, whatever the company is using. We already have clients today where the source data comes from a blockchain platform. In some cases, we have seen companies where you have the blockchain, where all the transactions are, occurring and recorded, and then you have a platform that the company may have created to query the blockchain and generate a certain type of scripts that they could use for management purposes or for the purposes of generating several different types of report. And when it comes to accounting for what makes it in your monthly close, the accounting team is probably getting these reports from the platform generated scripts or queries. So now as an auditor, I'm a little concerned because I don't know where the source of information is and if the source of information is complete and accurate. What if the query was not complete? What if the script had something in it that did not request for all the information that was needed to hand over to the accounting people so they can post an entry that is complete and not missing a certain form of information? So those are, again, some of the things that need to be considered when we are thinking about accounting fraud considerations. If you have a company that's, that's heavy on crypto transactions, whether trading, or it could be something as simple as paying vendors in Bitcoin, or paying vendors and employees in any form of crypto. We have seen situations where the assets or the nature of transactions are sometimes commingled in the same wallet, which means, the company may be using the same wallet to process payroll transactions, to process vendor payments, to, process related party payments. Best practice would suggest that we got to segregate, we got to keep these wallets separate based on business transactions and the purpose. And with that, looks like I have literally 15 minutes. So I'm going to cruise through really fast and leave some time for Q&A. So from an accounting challenge standpoint, I think I covered a lot of these. Like today, if we look at, blockchain and the platform that company may have created and the accounting system, none of the three talk to each other without some sort of tool or an integrator. Again, there are tools that are being built that are trying to do that, but they are not where they should be for obvious reasons, because technology is still immature and it's a relatively new space. So as accountants, I think it's going to be important to still have some form of reconciliation. It could be manual reconciliation to make sure that the flow of information between all these systems is complete and accurate, and we are not missing information when it comes to financial statements. I mean, end of the day, as accountants, we are going to get reports from the ERP system. If the ERP system is not talking to blockchain ledger or a platform, then it kind of defeats the purpose of us relying on something coming from an accounting system. I get this question a lot where, actually not a question, a statement where, well, we don't need auditors now that everything is going to be on blockchain, everything is verified and, everything is real time. Well, I don't think our roles are going away as auditors or accountants. I think it's just going to change significantly in the way we do things. And the way we look at companies, the way we understand a company, and the way we do reconciliation, or even pick a sample to test a certain set of information. So like, for example, in one of the common practices is in an audit, not common actually, one of the things in an audit is we are used to a sample-based approach where we pick samples of information to test. And hopefully that sample represents a bigger population, so you don't need to test the big population. We are also used to testing information that has already happened, things that transactions and facts and that have happened in the past. So we are used to testing historical information. We are used to looking at checklists and testing information based on an audit checklist that is designed based on the risk assessed. Well, for a blockchain company, a lot of this needs to change. If you have information on the blockchain, you're pretty much looking at real-time testing, real-time monitoring. So think about how that is going to impact us as auditors. Instead of going out at field 2 times at our client site to test, perform prelim and year-end procedures, we might be out there a lot more testing information real-time, just because now our client is using blockchain, and blockchain is, the ledger is tracking information literally on a real-time basis. We may not need to test we may not need to pick a sample of information. We might end up testing the population itself if we are going more towards a real-time test environment. So some of these things need to be considered. The other audit challenges that we are seeing commonly with CPA firms, including ours, where we had this challenge initially, is going through the client acceptance process. And the biggest challenge there is, again, the immaturity and the newness of the industry itself, and not knowing, what to expect. I have to, give a shout out to AICPA here. They have been working heavily in making some changes to propose standards, including standards on audit evidence, where our standards on audit evidence are years old. It does not consider emerging technologies like AI, blockchain, data analytics, and RPA. AICPA is proposing change of those standards to consider using these emerging technologies. How do these emerging technologies impact the way we are using tools today? So for auditors and accountants, there is help coming. There is some guidance out there. In fact, AICPA, we are working closely with them as a group. We are also, the AICPA is also going to have white papers out soon that talk about, that kind of gives some sort of a guidance on some of these accounting and audit challenges in the digital asset space. So there is help coming. And with that, I think I'll cruise through this real quick. So, one of the things I did want to assert, importance of getting a SOC 2, a Systems and Organizations Control Compliance report. One of the things we strongly believe in is, for a blockchain-based company, it's going to be very difficult to issue a financial statement audit without some form of compliance reporting on the internal controls over financial reporting process and non-financial reporting process. Back to my point earlier, where I had mentioned that, end of the day, if smart contract is driving your business decisions and executing transactions, we got to start looking at compliance over the internal controls over the functionality of the smart contract and the blockchain protocol layer itself, like looking at the consensus mechanism of blockchain, making sure confidentiality of information is protected. The right parties have access to the right information, and the appropriate parties are the ones responsible for validating transaction. So kind of testing, pretty much segregation of duties at the protocol layer. And some of these SOC reportings can do that. In fact, this is one of the things that we have started doing a lot for clients. And I'll be honest, it's not an easy process. It is not something, it needs to be customized heavily from traditional SOC practices to encompass all the blockchain complexities. Again, the future of auditors, again, to my point, I would, the one key takeaway would be, it's not too late at all. It's just changing the way we think and accepting that this is already happening, and bigger companies, at some point are going to start pushing vendors to start using their blockchain. So the last thing I would want is my client to be reactive to something versus being proactive. So at the least, have a discussion, with technology partners like Amanda at Boomer, and get an understanding of, how blockchain works. What are some good use cases? I mean, today we are talking to our clients and helping them think proactively that, oh, you have these business issues, or, here are some of the instances where you could consider blockchain. So at least kind of educational, so they are not missing out on something down the line. And, last and after this, Amanda, maybe feel free to jump in here. We have some publications on our portal. We just laid out two, but there's quite a lot on our website. I know at Boomer, Amanda, you guys have been thought leaders in this space. You have a couple of white papers that feel free to check these out. Wall Street Blockchain Alliance, I mean, you guys have done a fantastic job in putting together a very good group of members and thought leaders and educating companies, CPAs and non-CPAs out there in this entire space. So with that, Ron, I think I left literally 5 minutes for questions. I will stop talking.
Yeah, thank you, Jagruti. Thank you, Amanda. That's such great information and a lot of in-depth items for consideration there. We do have several questions coming in. Let me kick it off with a couple of them. And this one, let's start with you, Amanda. One of the conversations, you raised several use cases that were really important. And one of the questions that came in was, how involved does the accounting professional and technologist get into the conversation around token asset structures, utility tokens and security tokens? I don't want to go down the road too much there, but what's the role for the accounting professional and technologist in tokenomics in part of these conversations?
Ooh, that's an excellent question. And I think Jagruti can probably speak to it as well, but she really highlighted how important it is to really have make it a collaborative effort here. So, she and I can and have gotten together and talked about blockchain and talked about digital assets for hours on end. So what role do they play? I think it's a kind of, again, you have to gather as much information as you possibly can. So having these conversations, bringing in as many people, getting different perspectives is very important. So you want folks both on the accounting side and the technology side. I would even say bring in some of those, I'll call them the more experienced people in the public accounting profession, the ones that are really hoping that they can retire before they're impacted by blockchain. Bring those folks in, because when we changed to an e-commerce society and started leveraging the internet for commerce, that changed the rules of accounting and of technology. And Jagruti mentioned Walmart and their requirement to to opt in to the IBM Food Trust program. You know, Walmart changed the rules back in the day when they started requiring UPC codes. So we have a wealth of knowledge out there that we can leverage. They've been through, you know, these emerging technologies. They've been through, if you want to use the buzzword, disruption. They've been through those before. So bring them in and get their perspective as well. I think you need to get as much information from as many different perspectives as possible.
I'll also add one more thing, Ron. I think it is very important to also get legal counsel involved, especially if you have anything to do with token compensation, or if you are trying to do something called an STO, securities token offering, or an ICO, initial coin offering. You guys, some of you may know, but Blockstack, one of the companies, probably one of the first companies who actually registered with the SEC, and you know, it's they pretty much did an STO. So there will be a lot of disclosure requirements if you are going that route, and to determine whether you have to comply with securities law or not, it's important to get legal assistance and kind of follow whatever, depending on whichever Reg A, Reg D, you know, whichever regulation you're filing. Make sure your financial statement disclosures are consistent with that.
Yeah, that's an excellent point, Jagruti, and a great opportunity to give a shout out to the Wall Street Blockchain Alliance Legal Working Group, because I know they are doing a lot in that area as well.
Indeed. Thank you, Amanda. They really are, and particularly in the news around Blockstack and some of the recent Reg A offerings. It's an ongoing conversation there. I know we only have a few minutes. We'll probably go over, as we usually do, a couple of real quick questions. What kind of wallets do you think will gain traction? And I think this question is in the context of, from a technology perspective, we have custody firms, we have phone makers that are going to be releasing phones that will be wallets. From a regulatory perspective, from an accounting and audit perspective, what does that mean? How do we manage that, and how does the bandwidth of that activity impact the profession?
Wow, that's a good one. I'd almost say, Jagruti, can we start planning a webinar on wallets, the different types of wallets, and the audit considerations in there?
Yeah, that's definitely a loaded question. But I will say one thing: if you know, whichever wallet whoever is using, if it was me, I would definitely want to see some sort of cyber risk security plan on that wallet. Like, does the wallet provider have a have a SOC 2 done? You know, if it does, well, great. I would want to review that in detail to be able to comment. And if not, I think that is a risk consideration.
Yeah.
Thank you. So 2 last questions. I know we're running up against the clock here, but we're very privileged at the WSBA to have many professionals in the accounting profession and in the audit space as well. One of the questions was, can you discuss some of the outside crypto-only auditing services, and what do they add to the audit? And tying that together, what assurances do some of these firms bring, or should they?
So Ron, I'm trying to understand the question. So is it outside crypto? What do we mean?
Yeah, let me read the question. Can you discuss some of the outside crypto-only auditing services around things like smart contract processes or security audits, and what they add to an audit for the profession?
Oh, got it. Okay, I can take a shot at that, Amanda. So I think this goes back to a slide that I very quickly cruised through, but that's probably a conversation worth another 4 hours. So there's the reporting compliance audits called SOC 1, SOC 2, SOC 3, ISO 27001. These audits specifically focus on internal controls around financial reporting and non-financial reporting controls. Security of information, is the transaction flow secure? Is the information available? Is it accurate information? Is the process itself reliable? I think as an auditor, as a financial statement, if I can get comfortable over a process, its confidentiality, the privacy over it, the security, if I can't get comfortable over the process, it's pretty much pointless to put numbers on top of that process. I mean, it's a broken process. It's going to increase my audit risk, and I might end up doing a lot more substantive testing if I know that there's no sort of compliance certification done on the process itself. So, and very quickly today, there's really no guidelines on anything that is blockchain. So there's no checklist out there. But there are current standards like the SOC 1, SOC 2, and the ISO 27001, which is the global standards. They follow a certain set of existing standards. Those need to be customized and added for blockchain complexities. So it's not off, it's not just off the shelf type of audit that we are looking at. It needs to be customized based on the risk considerations.
Right. Thank you, Jagruti. One last question, which I think is important. I realize we're going a little bit over. How are crypto exchanges typically accounting for wallets that they host for their clients and the escrowing of funds for transactions? Are these off balance sheet? Which is an interesting question.
It is. And I think I will probably take that offline because the answer on a lot of follow-up questions.
Yeah, understood. Well, we're just about over 2 minutes. Jagruti, Amanda, again, as always, thank you so much for your thought leadership and expertise. Thank you all for our members who joined. We will make the recording available in the next several days as well. Anyone who's got additional questions, please reach out and let us know. Other than that, we will leave it there. Thank you all again very much.
Thank you.
Thank you, guys. Thanks, Amanda.